the IRS just quietly dropped the new 2026 capital gains brackets, and they come with a few sneaky opportunities for ETF and index fund investors. If you play this right, you can pay 0% on some of your long-term gains, keep more of your returns compounding, and avoid some nasty surprise tax bills in early 2027. Most people are going to completely miss this. You don't have to. If you're new here, I break down investing and taxes in plain English so you can grow wealth without needing a PhD or a spreadsheet addiction. In this video, I'm going to walk you through what actually changed in the 2026 capital gains brackets, how to use the 0% and 15% brackets to your advantage with ETFs and index funds, why ETFs are usually more tax efficient than index mutual funds, and how to use smart asset location and tax loss harvesting so your taxable account stops leaking returns. Then at the end, I'll pull it all together into one simple playbook you can use every year. So let's start with the big question. What actually changed? The short answer is this. The capital gains tax rates didn't change, but the lines did. And the lines are where the strategy lives. For long-term capital gains in 2026, that's gains on investments you held more than 1 year, the rates are still 0%, 15%, or 20% based on your income. What changed are the income thresholds. They moved up for inflation. Roughly speaking, there's a 0% long-term capital gains rate up to a certain level of taxable income, then a big middle zone where you pay 15%, and above that, the 20% bracket. The exact dollar amounts will depend on your filing status, single, married filing jointly, head of household, but the idea is the same. The first slice of your long-term gains can be taxed at 0%, the next slice at 15%, and the top slice at 20%. Two clarifications here that a lot of people miss. First, these thresholds are based on taxable income, not your salary number. Taxable income is what's left after your standard deduction or itemized deductions. So if you make, say, $80,000, but you take the standard deduction, your taxable income is meaningfully lower than $80,000. Second, short-term gains are a completely different animal. Anything you held 1 year or less doesn't get these special rates. Short-term gains are taxed as ordinary income using the normal income tax brackets, those numbers that go from 10% all the way up to 37%. That's why holding period matters so much. And don't forget the standard deduction. That also got bumped up for 2026. The higher the standard deduction, the more of your income gets shielded before you even hit those capital gain thresholds. So your taxable income, the number that actually matters for these brackets, starts after that standard deduction is taken out. Let me make this real with a quick story. I was talking to a friend, we'll call her Sarah. She's married, mid-40s, they invest mostly in broad index ETFs in a taxable account plus a 401k. When she heard new capital gains brackets, her reaction was basically, cool, so that means my refund will be different? That's how most people think about it. Whatever, my accountant will figure it out. But when we walked through her numbers, we realized something big. In 2026, she and her husband expect around $80,000 of total income in a semi-sabbatical year. After the standard deduction, their taxable income would be somewhere under the top of the 0% long-term capital gains bracket for married filing jointly. Translation, they could realize tens of thousands of dollars in long-term ETF gains at a 0% federal rate in 2026 and still be under that bracket. Her mind was blown. She'd been afraid to sell anything, assuming she'd get hammered with taxes. There is one more layer that hits higher earners that you need to know about, the 3.8% net investment income tax, or NIIT. That's basically a surtax on investment income, things like dividends, interest, and capital gains. It kicks in when your modified adjusted gross income goes above a certain level. For most people, that line is $200,000 if you're single or $250,000 if you're married filing jointly. And here's the kicker. Those NIIT thresholds don't adjust for inflation. So over time, more and more people just slowly drift into that zone. Once you're above those levels, your effective tax on long-term gains can be 15% plus 3.8%, or 20% plus 3.8%. That's a huge jump. And that's why just set and forget in a taxable account can be expensive if you're in a high income phase. So Now that you've got a feel for how the brackets work, let's talk about how to actually use the 0% and 15% brackets to your advantage, especially if most of your investing is in ETFs and index funds. Here's the fun part. You can actually harvest gains and pay 0% federal tax on them on purpose. Most people have heard of tax loss harvesting, selling losers to capture a loss for tax purposes. We'll come back to that later. But with the 2026 brackets, there's a huge opportunity on the other side, which is tax gain harvesting inside the 0% long-term bracket. Here's how that works in simple terms. Let's say you're married filing jointly. You expect $70,000 of total income in 2026, and you take the standard deduction. Maybe your taxable income ends up around the high 30s. The 0% long-term capital gains bracket for married filing jointly goes up to a number that's significantly higher than that. In very rough math, that means you've got a big chunk of space between your current taxable income and the top of the 0% bracket. Inside that space, you can realize long-term gains from your ETFs and index funds and still pay 0% federal tax on those gains. Now, in real life, the math gets a bit twisty because when you realize gains, you're increasing your taxable income. It's like filling a bucket. Every dollar of gain you realize raises the water level. But conceptually, you get this window where you can trim positions, rebalance your portfolio, or reset your cost basis without paying capital gains tax on the federal level. Why is this so powerful for ETF and index fund investors? Because long-term index investors often have big embedded gains in things like S&P 500 ETFs or total market ETFs. They have positions they'd love to simplify or change, but they're afraid of the tax bill. And many know that in the future, their income might rise, or they might sell a business or exercise stock options, and that could push them into higher brackets. Using a lower income year, a sabbatical, a career change, an early retirement phase, or maybe a year when one partner stays home with kids, to harvest 0% gains can let you increase your cost basis, so future gains are smaller, let you clean up your portfolio, like going from 10 random funds down to 2 or 3 core ETFs, help you shift into more tax-efficient ETFs without the usual tax pain of selling. I went through this with a couple who had a messy mix of old active managed mutual funds, a few index ETFs, and some random sector ETFs they didn't even believe in anymore. We realized 2026 would be their last low-income year before one of them went back to a high-paying job. So they used that year to sell several legacy active funds, roll into cleaner, low-cost index ETFs, and stay within the 0% long-term bracket. They basically cleaned up their taxable account and reduced future tax drag without writing the IRS a check for it that year. Now, even if you're nowhere near the 0% bracket, there's still strategy in the 15% zone. A lot of upper-middle income households live in the 15% long-term capital gains bracket, even when their ordinary income rate, the rate on their salary and short-term gains, is higher. That means harvesting long-term gains at 15% now can be smart if you expect to be in the 20% plus 3.8% NIIT zone later. Think about pre-IPO employees, business owners planning to sell in a few years, or anyone who expects a big income spike on the horizon. You're basically choosing between pay 15% now on my schedule or maybe 23.8% later on the government schedule. Obviously, this is the kind of thing you want to double check with a tax professional, but the key idea is, once you know where the lines are, you can make conscious choices about when to take gains. Now, let's zoom out and talk about something that quietly makes a huge difference in taxable accounts: the structure of what you invest in, ETFs versus mutual funds. Two funds can hold almost the same stocks, but one quietly sends you a tax bill every year, while the other mostly doesn't. That's the structure difference between most ETFs and traditional mutual funds, and it matters a lot when you're investing in a taxable account. Most broad index ETFs have two big advantages. First, they tend to be passive and low turnover. They're not constantly trading in and out of positions, so they don't trigger as many capital gains inside the fund. Second, they use an in-kind creation and redemption process. When big investors create or redeem ETF shares, the fund can hand off securities in kind instead of selling them for cash. That helps the ETF avoid realizing taxable gains that would otherwise get pushed out to you. With many broad index ETFs, capital gains distributions have historically been rare or tiny. You still get dividends, of course, but those surprise capital gains distributions are much less common. I learned this the hard way. Years ago, I owned an actively managed mutual fund in a taxable account. I'd bought it because it had a great star rating and everyone online was hyping it. I didn't sell it for years. Then one December, the fund announced a massive capital gains distribution, something like 15 or 20% of the fund's value. I basically got a tax bill on a gain I didn't ask for without any extra cash in my pocket to show for it. If I'd owned that same exposure via a broad ETF instead, there might be zero capital gains distribution. I would have more control over when I realized gains, because I'd only owe when I actually chose to sell shares. That's the core difference in taxable accounts: control. Now tie that back to the 2026 brackets. We've got the 0% bracket up to a certain level, a big middle zone where you pay 15%, and the top bracket at 20%. On top of that, we've got the NIIT thresholds where that extra 3.8% kicks in. Every unnecessary